that also has me wondering. Tom made this comment this morning on Let Me Explain. He said that the wall of worry has disappeared.
I'm going to play devil's advocate.
Sure.
Only because that's what makes the show fun.
Absolutely.
And I kind of feel like that is a little bit of the masters of the obvious outlook. And that if you were bearish for whatever reason, or you wanted to be cautious, the reason to be cautious right now is that we are no longer riding a wall of worry. The optimism has flipped, and nothing would make more sense to me than the market selling off on good earnings. As the ultimate contrarian inside of me says that it's just not that easy. And some of these run-ups and some of this multiple expansion has been so strong, and yet it's left different groups, in its wake.
I don't really feel that way per se, but then again, when I was looking around and just doing this thought exercise today, who cares that the Fed's going higher for longer right now, or about what's happening in Eastern Europe from a market's perspective? Obviously not downplaying the tragedy and loss of human life, but do the markets care that the Black Sea grain initiative has been dissolved? No. Wheat prices, they had a little bounce, they came right back in. I mean, nothing is getting anyone out of bed for any reason right now, and that is a little bit of complacency we haven't felt in a long time, it feels like. Years.
I would say going back to pre-pandemic. I mean, we haven't seen these volatility levels in that since that period of time before the pandemic. Volatility, being in the VIX in the 13 handle. I don't think we saw that at all over the last couple years. And I understand what Tom's thinking, but I agree with you. I think there is still like the narrative that stuff is really bad and that there's like this big Armageddon on the horizon. But we've already kind of gone through that, right? So like I feel like at this point we've kind of digested it. And the market itself has digested it. And when I look at some of the stocks, going back to like your Apple, our discussion on Apple, yes, you've got Apple and Microsoft at highs, and NVIDIA has had a insane rally. But looking back at some of the middle of the year or the stocks, their charts middle of last year, when you look at a Google or an Amazon or Tesla or some of the lesser names like your Squares and Roku and PayPal and stuff like that, none of those stocks have really participated in the upside. And so even if you get kind of a stalling of the big names and the big names kind of flatten out, if you get a bid from some of those, the second tier of stocks here, maybe that's the push higher. I just think overall we've digested it. We've gone through a whole lot, and I feel like there's the meteor never came, and so we didn't get that big one.
I know a lot of the big names are doing a lot of the lifting right now. Mm-hmm. You can just see how QQQ has outperformed QQEW over the past several months, just as a testament to that. But this is a market rally with broad participation. I mean, the number of NASDAQ stocks trading above their 200-day moving average is now at 81.2%. It hit its high in 2021 in February of that year, right around 92%. Mm-hmm. So there's still room for this rally to run. And more importantly, when did the NASDAQ top? Did it top once we hit that, nice round number, 90%? No. The NASDAQ didn't top until November of 2021. So there are still legs. There is still opportunity for that breadth to widen out and continue to carry us higher. And quite frankly, it's more participation from some of the, I don't want to call them this, it sounds derogatory, but losers this year so far. Those people participating, those stocks participating, that's actually a really good sign. It's why I think this market has legs, because of what's just happening with the Russell. I can't think of the four major indices. Yeah, sure, rising interest rates and tech profitability, that's always a problem for the NASDAQ. But for the Russell, there's a clear and present danger, which has been this regional banking crisis. And this keeps breaking out. Jamal and I were surmising a few days ago, actually last week early, we're saying, if we begin to see a breakout here, forget the narrative. Triangle consolidation after a breakout from a downtrend is a continuation effort higher. That looks like this market wants to get back to its yearly high. here we are now basically 90 points on the other side of that call. What's going to stop the Russell from clearing out its highs at this point? But I guess the important indication is if the Russell can rally, why can't everything else still too? So it's really difficult to get bared up when you see this kind of price action in, again, the most bogged down index of the major four.
It's the only one that hasn't moved. The Russell. I mean, like now it's participating a little bit, but the Russell is sitting exactly where it was in 2021. Yep. I mean, like it's not up 30, 40% like the NASDAQ is. It hasn't moved. And you're right. It's like if that's going to start moving, then maybe it is all clear. And, you did get a lot of good results on the quote unquote banking sector. I know the regional banks are much smaller, but if you look at like what Schwab did this morning and Morgan Stanley, you got a couple of the names coming next week as well. JP Morgan, I know it kind of ended the day flat, but it's had a significant move higher. Maybe you get kind of a lift back in those stocks. If you look at KRE, KRE has had a really nice move higher over the last, week or so, going from the 40s to the 45-ish handle. I mean, that's no small move. That's 10, 15% over the course of 2 or 3 trading days.
And KRE has actually made an important turnaround here. There's actually a double bottom in play right around the 40 level. And you can see that because we poke through the intermediate high there once we jump through $42. But the ascending trend line, Nick, when I look at this from the May, from we call it the, maybe not the June, but we'll call them the intermediate interim May swing lows here. Once we broke down through, I think a lot of people started to get bared up, myself included. All of a sudden today, poking her head back above, okay, yeah, it's a trend line. I drew it. It may be totally meaningless. But at least from how I slice and dice this market, even the banks, they look like they're getting on better footing. And in doing so, we've now climbed to our highest levels going back to the early days of the crisis itself. We're getting a pretty clear signal here that no one thinks that any more skeletons are going to fall out of the closet. And if they do, we have the plumbers down in D.C. to mop up the mess, the Fed, the Treasury, and the FDIC.
Yeah. I mean, do you think that some of it is the market at least digesting the fact that rates will remain high / go higher, and that, the worst is kind of behind us? Is that why there's a little bit of a bid in the regional banks, or is it, consolidation? Like, did we get the bad actors out of the market, and now, everybody that's in there, maybe they have a little bit of problem, but over a long period of time, we're fine? Like, what's your thinking on that?
We definitely cleared out some of the more egregious actors in the space. The metrics that we were looking at when the banking crisis started were, percent of uninsured deposits relative to the tier 1 capital ratios. And you have a bank like SVB where that number is like 90%. Like, they're just outrageously high, and they have these large unrealized losses sitting on their balance sheet. There's no way that the deposits could cover them once they started to flee. Now, when you look at this, right, yields are going down. So not only are the pressure on net interest margins dissipating, particularly as we see the 210 spread shift the way that does, I also think that as those short-term yields come in, money market funds become just that marginally less appealing. And it's the high rates that money market funds offer that has been provoking some of this depositor flight. And then you want to put in a third layer, right? Well, if they have all of these unrealized losses as a result of treasury bonds that are sitting underwater, well, the fact that bonds have been rallying recently, that means those unrealized losses are shrinking. So in one fell swoop, we can't even forget the equity. The equity of these banks is improving. That's also part of the equation. So everything is kind of working together, this gigantic positive feedback loop right now that's making everyone feel a little bit calmer. It's one hand washing the other. Lower yields help the banks, and that in turn helps the broader stock market.
What's moving rates right now? I admittedly haven't even been looking at the 210 spread over the last couple days or so. What did I miss something? What did I miss? Is it just that
more
everything
sellers?
Yeah, no, I know. Is it just that we're stabilizing and that inflation is getting lower, so the speculation of interest rates moving forward is kind of flatlining? I mean, is that the sentiment here?
It definitely feels like there are more legitimate deflationary impulses in the system that will obviate the Fed's need to ultimately raise rates up to 6%.
Okay.
Right. And so given the strength of the labor market and the broader economy right now, not saying things can't get worse, people really have a hard time distinguishing those two. I'm giving an assessment of what the weather is outside right now, not the forecast a quarter from now. Right now, it's still sunny. And so you kind of have this Goldilocks zone where inflation has come in. You know, you look at the scoreboard, as I like to say it here on Overtime. A year ago, the economy contracted by 0.6%. The unemployment rate was 3.6, and inflation was 9.1. Now the unemployment rate is 3.6%. Inflation is 3%, and the economy is likely to grow at 2% this quarter. I mean, that would be the best case scenario if you said that a year ago, and you would have been laughed out of the room saying that it was possible. The S&P 500 is actually higher now than it was when the Fed started raising rates, if you can believe it.
Yeah.
So for me, it seems like the market is actually comfortable. The Fed got this. The soft landing is here. We're living through it right now, and we don't necessarily need to see higher rates. And I can pull it up here momentarily, but one of the important indicators that's coming out that's giving people reassurance that inflation has been tamed, within the ISM services index, the prices paid component, if you advance that by 3 months and you take a correlation between that and headline CPI over the past 10 years, that full 10-year set of data, 120 data points, the correlation between the two is 0.92. Positive.
Okay.
And so right now that points to an inflation rate headline year over year closer to 1.5% by September, which means any base effects in the system, which are going to start to turn against us, not really going to matter. That's mission accomplished for the Fed. Then they could start cutting rates. They don't need to hold rates at this higher for longer level for years, even if that's their posture. And, telltale sign of a market that thinks the economy is going to improve. Look at how earning multiples have moved up since October. There's been no earnings growth yet because that earnings growth typically kicks in 9 to 12 months after the equity markets bottom. So all in all, I mean, I'm seeing just plenty of signs of a market that kind of went from late cycle, skimmed by the recession trades, and is starting to behave more early cycle again. You're seeing cyclicals, technology, communication services, now even the banks participating, industrials have thrown their hat into the ring. Those are all the kinds of things you want to see in a cyclical bull market. It's hard to dislike.
Yeah, I hear you.